If you're in your 20s or 30s and aim to achieve a comfortable retirement, even though it may seem far off, you may have limited options, but one of the most advantageous choices is to begin investing early. It's a logical conclusion that to lead a comfortable life requires a substantial amount of wealth. Investing money is one of the most effective methods, particularly for the working class, to accomplish this. Starting investments early will significantly increase your wealth. By starting early, you're establishing a foundation for future success. Today's video will explore some crucial assets and investment decisions that are particularly valuable for young individuals. Now, let's get started. Startup businesses. Investing in a startup business is a valuable investment to consider in your 20s. The potential for high returns is remarkable, as the earnings from a successful business can be unlimited, offering an unlimited return on investment (ROI). You don't necessarily have to start your business. You can invest in other people's businesses in exchange for equity. One option is to become an angel investor, particularly if you have a personal connection with the founder. Your investment can take the form of a convertible note, which means it may convert into a loan based on specific criteria being met. Crowdfunding platforms provide another avenue for investing in startups. These platforms showcase a variety of startups with high growth potential. Before investing in a company, it is crucial to thoroughly research the founder and understand the story behind the company. Look for companies with compelling storylines and founders with relevant education, experience, or training in the business industry. Investing in a startup business can be a dynamic and potentially lucrative opportunity, particularly when initiated at a younger age. However, it is essential to conduct thorough due diligence, assess the potential risks, and carefully consider the qualifications and backgrounds of the founders before making any investment decisions. Index funds. When constructing your index fund portfolio, it's advisable to consider incorporating bonds as well. While bonds may have lower return rates, they provide a higher level of security. It is recommended to allocate around 10 to 20% of your portfolio to weighted bonds to ensure a more secure investment. Additionally, you can adjust this percentage based on your risk appetite. Recently, crypto index funds have emerged, showing promise despite not being fully tested. These funds currently offer return rates ranging from 10 to 15%, which is considerably high. However, it's important to acknowledge that as the return rate increases, so does the associated risk. A significant advantage of index funds is their low fees. Lower fees result in higher returns. Furthermore, besides diversification, many index funds also have low fees. Investment fees can quickly diminish your returns, so minimizing them as much as possible is essential. When purchasing index funds, be mindful of the tax implications as well. Treasury bills. Treasury bills are indeed essential investments for every investor, regardless of age. However, there is no better time to regularly buy treasury bills than when you are young. Treasury bills are short-term debt instruments issued by the government to fund expenditures and control the money supply. They are typically available in three tenors: 90 days, 182 days, and 364 days. Investing in treasury bills can be advantageous for various reasons. Firstly, it allows you to allocate your available funds to these bills and easily cash out when they are mature, enabling you to cover expenses such as tuition, rent, or professional exams. This approach aligns with the finance concept of asset and liability matching, where an asset is required to finance a future liability. Moreover, treasury bills are considered risk-free investments as they are backed by the government, guaranteeing returns. Unlike other investment options, you can rely on guaranteed returns from treasury bills. Additionally, the returns on treasury bills are typically decent, making them an attractive investment choice. Real estate. Real estate is considered one of the best assets for several compelling reasons. Firstly, there is typically a housing deficit, which means there is consistently high demand for housing. As a result, real estate assets tend to appreciate over time. The first step in real estate investing is often purchasing your own home. You can reduce expenses like rent and build equity by owning a residential property. Once you have acquired your home, you can explore opportunities to invest in other real estate properties, such as multi-unit homes, townhouses, offices, and more. However, if you cannot invest directly in the real estate market by purchasing properties, alternative options are available. Crowdfunding platforms allow individuals to invest in real estate with smaller amounts, sometimes as little as $500. The invested funds are pooled with contributions from other investors and collectively invested in real estate properties. These investments are commonly known as real estate investment trusts, REITs. REITs allow individuals to invest indirectly in real estate and benefit from potential returns without the need for direct property ownership. Growth stocks. Growth stocks are stocks that are anticipated to grow at significantly higher rates compared to the industry average. These stocks typically generate sustainable positive cash flows and revenues, outperforming their peers regarding growth potential. Investing in growth stocks allows you to participate in the growth of these companies and potentially benefit from substantial capital appreciation over time. On the other hand, dividend stocks are stocks of financially stable and mature companies. These stocks tend to exhibit lower volatility compared to growth stocks. Dividend stocks are known for providing consistent income over a long period, assuming the companies continue to perform well. Including dividend stocks in your portfolio, particularly at a young age, allows you to generate a steady income stream through dividend payments, which can be reinvested or used for other purposes. Growth and dividend stocks have advantages and can play a role in a well-diversified investment portfolio. Education. Studies indicate that your 20s are optimal for learning and acquiring new knowledge. Research suggests that during your 20s and early 30s, it is generally easier to grasp and assimilate new information. Consequently, this period could be an opportune time to pursue an additional degree or further your education. Education plays a crucial role in setting the stage for career success. However, it's important to recognize that not all forms of education or learning can be considered assets. When pursuing education, it is essential to exercise caution, as certain forms of learning may be categorized as hobbies and may not necessarily lead to monetization or financial gains. If you're investing in education, exploring careers that align with your interests and have the potential for success is advisable. This could involve identifying fields or industries where you have relevant skills and experience. Your 20s can also be an ideal time to enhance your financial literacy. Developing a strong understanding of personal finance and investment principles during this phase of life can lay a solid foundation for your financial well-being in the future. Annuities. Annuities are financial contracts between an individual and an insurance company. In an annuity, the insurance company guarantees to make periodic payments to the individual immediately or in the future. Annuities can be purchased through a single payment or a series of premium payments. There are different types of annuity contracts available. Some annuities are designed as saving vehicles for retirement, allowing individuals to accumulate funds over time. Others can be used to convert savings into a stream or retirement income. Certain annuities serve both purposes. If the annuity is used for saving and the payment is deferred to a future date, it is referred to as a deferred annuity. On the other hand, if the annuity is used to generate immediate retirement income, the payments start immediately, known as immediate annuity. The two most common types of annuities are fixed and variable annuities. Fixed annuities provide a predetermined interest rate and guarantee a specific payment amount, while variable annuities allow individuals to invest their premiums in a selection of investment options, and the payment amount fluctuates based on the performance of the investments. There is also a hybrid type known as an indexed or equity indexed annuity, combining fixed and variable annuity features. Cryptocurrency. Cryptocurrencies and initial coin offerings, ICOs, have gained significant interest, especially recently, attracting both traditional and new investors. The market has witnessed billions of dollars being raised through ICO financings, and there are now over 1,000 different cryptocurrencies available, making these markets highly enticing for investors. However, it is crucial to note that cryptocurrencies and ICOs are complex investment products, and it can be challenging for individual investors to fully understand their intricacies and assess their risk levels accurately. What is evident is that cryptocurrencies have exhibited incredibly high returns. The returns on investment can range from 12% up to 200% or even higher. Some ICOs have demonstrated exceptional performance, such as the example of OTA, which had a return on investment of 13,000 times. If you had invested $1 during the ICO, it would have grown to $13,000. It is important to approach investments in cryptocurrencies and ICOs with caution. While they offer the potential for significant returns, they are also known for their volatility and can involve substantial risks. The value of cryptocurrencies can fluctuate dramatically, and there have been fraud and regulatory concerns within the industry. Exchange-traded funds. Exchange-traded funds, ETFs, are investment vehicles similar to the index funds mentioned earlier. ETFs consist of baskets of securities that can include various assets, such as stocks, bonds, and gold, resembling index funds in their composition. One key characteristic of ETFs is that they trade like stocks on exchanges, allowing investors to easily buy and sell shares throughout the trading day. This liquidity and traceability make ETFs flexible tools for investments. They can track broad market indices like the S&P 500, providing exposure to the overall market performance, or they can focus on specific sectors such as technology or healthcare, and even subsectors like social media or robotics. Some examples of ETFs include the Schwab US Large Cap ETF, which tracks the performance of large cap US stocks, the Global X Robotics and Artificial Intelligence ETF, which focuses on companies involved in robotics and AI, and the iShares Global Clean Energy ETF, which targets companies in the clean energy sector. Commodities. Commodities refer to economic goods, typically resources that are highly fungible, meaning instances of the goods are treated as the equivalent in the market regardless of their specific origins. There are several ways to invest in commodities. One approach is to purchase physical raw commodities, such as precious metal bullion, in varying amounts. Investors can acquire these tangible assets directly, providing ownership of the physical commodity. It is important to note that investing in commodities through futures contracts and ETPs can be highly volatile and complex. These investments are typically recommended for sophisticated investors who deeply understand the underlying markets and associated risks. Commodity investments offer several advantages. They contribute to diversification in an investment portfolio, potentially providing a hedge against inflation, as commodities have historically shown robust performance during inflationary periods. Moreover, commodities have the potential for attractive returns, especially during rising prices or global demand. Investors must conduct thorough research, understand the risks involved, and consider their investment goals and risk tolerance before investing in commodities. It is always important to take calculated risks and well-informed choices when investing. Start early and educate yourself first. That's it for this video. Thanks for watching.